On July 5th, Bitcoin's price expanded violently, moving from 62,000 to 64,000 in hours. Using traditional technical analysis, like plotting static support and resistance lines, makes it difficult to predict exactly where a move like this begins or ends. However, viewing the same period through market microstructure data reveals the underlying logic. This visualization maps forced market orders rather than standard volume profiles. These neon bands indicate massive clusters of highly leveraged long and short liquidations waiting for a price trigger. In modern algorithmic markets, price action is rarely repelled by resistance levels. Instead, price is magnetically attracted to these liquidity pools because they represent guaranteed execution for large institutional participants. To understand this mechanic, we will use a chronological forensic framework, tracking a continuous 6-day window of market data from July 4th to July 10th. Our objective is to map how these leverage clusters form and how they dictate both the direction and velocity of short-term price vectors. This data explains why the market consistently wicks past stop losses only to immediately reverse. For large institutions, hunting these zones is a structural necessity to avoid severe slippage when entering or exiting large positions. Understanding this gravitational pull is the difference between managing volatility and being caught within it. On July 4th, the market entered sideways consolidation. Dark purple areas indicate neutral zones with low leverage density. Bright bands are high leverage indicators. Green shows moderate density, while bright yellow denotes massive liquidation concentrations at 61.5K and 63K. As the price moves sideways, retail traders continuously add to leveraged positions, causing these bands to thicken and intensify. These eventually crystallize into distinct horizontal targets sitting just outside the current trading range. For automated algorithms moving significant institutional size, these bands represent the only viable zones for guaranteed counterparty liquidity. This demonstrates a core rule. Periods of low volatility are the incubation phases that build the fuel for the next price expansion. By July 5th, we can see aggressive buildup in specific target zones, particularly around the 64K and 62K levels. The yellow band at 64,000 shows extreme density. This band is a cluster of highly leveraged short sellers. As the price climbs, it is drawn directly toward this concentration. Just before the breakout, the price vector moves directly underneath the densest part of the pool. At 1600, the first layer of short positions is liquidated. These traders must buy, adding immediate market buy pressure. This triggers a cascade. Initial forced buys drive price higher, hitting the next level of liquidations in a self-sustaining loop. Once the liquidity is consumed, the price advance stops. The dense 64K band has been entirely cleared from the map. Without the fuel of forced orders, the price vector loses its momentum. The mechanical consumption of engineered liquidity drives these rapid breakouts, moving past the need for broad shifts in market sentiment. On July 6th, the topside liquidity was drained, forcing the market to reset and seek targets in the opposite direction. Immediately after, the price action dropped sharply, plummeting back below the 62K level. Traders who entered long positions during the rally had inadvertently created new liquidation targets below the current price. The market immediately reversed to target these new long liquidation pools, dipping to 61.5K to consume the density before recovering. By July 9th, the market was trapped between two competing leverage clusters. This creates a volatile ping-pong dynamic, where trading algorithms aggressively sweep both sides of the order book to find guaranteed execution. First, the downward sweep clear out the early longs, hitting the yellow band at 61K. Then, the immediate reversal, climbing back towards 63K to catch the shorts who entered late on the drop. The continuous market cycle follows 4 steps. 1. Consolidate. 2. Build leverage. If we track the historical price path, we see it intersected and destroyed the brightest yellow bands in a sequential order. For quantitative analysts, standard technical indicators are secondary to the distribution of market leverage. This distribution is the primary driver of short-term price volatility. The modern market functions as a mechanism designed to seek out and consume these pockets of forced orders. To trade without mapping these zones is to trade blindly. You are either aware of the liquidity pool or your position is a part of it.